to connect with Pankaj Tibrewal as well, find out his outlook on the markets as well as the way ahead. Pankaj, good to have you. And the question is, with the sort of negative undertone that we're seeing across on Wall Street with the rising bond yields, etc., do you believe that that poses a major threat for our own markets? Or do you think that we're going to continue to hold out and these are just mere bumps along the way?
Good morning. I think in the near term, there are headwinds both from global and local, economic data which are emerging. Globally, clearly, we have seen 10-year bond yield inch up to 4.8. Crude is at $95, no longer at $75. And clearly, the commentary coming out from Fed is that rates may remain higher for longer. So clearly, that may pose headwinds for equity markets, globally speaking. In India also, there's a dichotomy which is going on currently at the ground level. Consumption on one hand seems to be on the weaker side, especially the lower end of the pyramid. And clearly the volume growth of many companies in the first quarter also in consumer staples suggested that. Also, if you look at some of the other parameters like savings bank growth in FY23, it was flattish. Personal income tax growth in the first 4 months seems to be at around 4 to 5%. Whereas on the other side, when you look at B2B businesses, whether it be cement demand, whether it be power demand, they continue to be very strong. Order inflows continue to be extremely strong. So there's a dichotomy at the ground level between consumption and B2B businesses. Our sense is that consumption to around the second half of this year should start picking up, led by festive season, as well as election spending. And don't forget that this time, the wedding dates in the second half are about 35, 36 days, which is one of the highest over the last 4-5 years. So I think broadly speaking, in the near term, markets may face headwinds. However, if you take a 3 to 5 year view, I think India is very, very nicely positioned from an economic cycle perspective.
Right. Pankaj, what one has seen is that despite the bit of an aberration that the small and mid caps did face, and, that too in just various concentrated overheated pockets within the mid and small caps, when the market did come off from that all-time peak, last month, the broader market has been a lot more resilient and, it's surprised many on the street as well. Do you think this outperformance of mid and small caps vis-a-vis large caps is here to stay for some more time?
So in the near term, we are cautious on mid and small caps, and there are many data points suggesting that one should carefully navigate this space in the near term. And let's look at 4-5 data points which have helped us across cycles spot the excesses on both the sides. The first is the market cap distribution and profit distribution. So if you look at the market cap distribution today, large cap, which is the top 100 companies, have come down to about 65-66%. And mid and small caps are now about 34-35%. And especially in that, small cap is about 16-17%. But when you look at their profit distribution, the top 100 companies constitute about 75% of overall profit of India Inc. And mid and small caps constitute about 25%. So there is a disconnect between the market cap distribution and the profit distribution right now. The second is if you look at the earnings yield, which is nothing but 1 by P, the earnings yield of large, mid, small, micro are virtually the same, which means that the valuations have converged significantly. Generally, we have seen over the last 2 decades that there's a discount which normally happens because they tend to be more volatile than the large caps. But this time, the earnings yield of large, mid, small are virtually the same, hardly any discount, which suggests that we are nearing the greed zone on mid, small, micro. The third, if you look at, is that we track something called greed and fear indicator. The greed and fear indicator suggests that today everybody wants to own mid, small, micro, and nobody wants to own large caps. Our sense is that the same was repeated in 2017. Though today it's a lesser extent, but 2018-19, we saw the broader markets correcting, but Nifty was held on where it was. Can we see a similar repeat to a lesser extent this time around? possibility is yes, because the divergence between the performance of broader market and Nifty has been significantly higher this time around in the first 6-7 months. And there are pockets in mid and small caps which are overheated as we speak. So one needs to, kind of closely watch it out. Last but not the least, if you look at the Google trends, you will see significant amount of interest in small caps, names, small cap companies, small cap funds. And mind you that the flow in the small cap space over the last 6-7 months has been significant. Uh, if you look at more than 28 to 30,000 crores of inflow into the small cap funds, and the free float has not increased that much. So a lot of money chasing little stocks probably, and now market participants navigating from higher quality to lower quality. This is something we need to be a little worried about, and hence our cautious stance on mid and small caps in the near term. But if you take a 3-5 year view, I think the space is always exciting. There are bottom-up opportunities, and as we speak, we believe it will be a more of a stock pickers market rather than painting the entire sector with the same brush.
Pankaj, I wonder where you stand when it comes to the entire IT space, because of late the street is also getting a little bit negative, saying that there is no convincing signs of a pickup in tech spends, as well as the fact that the demand trends continue to look rather mixed. So what is your stance on IT?
So whatever channel checks we have done, the demand continues to be a little weaker. And our sense is that the US recessionary trends probably will weigh on IT spends as you move ahead. However, the good news is that the wage hike probably is behind us. In the last 3 quarters, if you look at most of the large IT companies have seen net de-escalation in employee count. And this we have not seen for a long time. So probably demand supply is not against the IT companies, so margins will be protected. But demand continues to be softer unless we see significant pickup in order wins in 2025, fiscal year 25. But probably in the next couple of quarters, demand is expected to be weak, which will weigh on the valuations of most of the larger IT companies as we speak.
Oh, well, yes, and a lot is weighing on the market because the Nifty is below 19,400. ICICI Bank, Reliance, Axis Bank, NTPC, these are the big culprits which are dragging the markets even below the mark of that 19,400, which we had seen last in the month of September, thereabouts. But Pankaj, what about the entire discretionary space? Because of late we had seen that pickup happening in terms of, whether it's a QSR, whether it's tourism, whether it's autos, etc. Do you think that will slow down, or do you think that is likely to continue?
I think barring near term where there could be ups and downs, I think India is in a very sweet spot as you look at the per capita income. We are at $2,400, and over this decade probably will move above $5,000. And this is a time where really the J curve kicks in, and many sectors in consumer discretionary would see a very significant pickup. Uh, we believe that you have to look consumption in three parts, divide India into three parts. India 1, which is about 15-20 crore people, India 2, which is another 20-25 crore people, and India 3, which is the remaining, which is the daily wages, the rural people, and so on and so forth. I think you have to position yourself in discretionary in India 1 and India 2, because that's where the aspirations are moving, and that's where the real consumption is happening. So we look consumption with a slightly different lens as far discretionary is concerned. Many sectors appeal on that. And I said at the start of the conversation that second half we believe discretionary spend should pick up, led by 35, 36 wedding dates, led by election spend, both at the center, at the state level, and led by festive season, which is pushed on to the third quarter this time around. So many franchises which have consolidated over the last 2-3 years, valuations have moderated. Probably our bias towards them will be positive as we speak from a 3-year, 5-year perspective. And we would look to own some of those names as you move ahead.
Quite interesting. Pankaj, where within that lies your tilt within the large caps?
So large caps, I think if you look at the BFSI space, the private sector banks, they have, I think, meaningfully corrected on valuations and time correction has happened. I think that pocket looks to be reasonably valued. Again, coming to autos, I think being a cyclical sector, that sector also is reasonably poised. The third is the infra space, and on the large cap, there are not many names, but whatever few names are there on the infra space, that sector looks to be reasonably valued. And tactically, we have to play the IT sector. Whenever we see that the earnings downgrade cycle is behind us, probably IT sector would start also look to be good. And sorry, I forgot on the pharma. I think pharma sector incrementally, I've been saying for the last 6 months, we continue to be positive. First quarter, we saw that after a long time, the entire pharma cohort reported 22 to 24% earnings growth. We believe the trend should continue in this quarter also, led by a decent US traction. Our channel check suggests that US price erosion has been much lower than what we have seen in the last 4 5 years, and many Indian players incrementally should benefit, at least in the near term, from the you know from the lower price erosion which we have talked about. So I think pharma incrementally is also looking quite okay.
That's quite nice, Pankaj. Great to have you on the show today. Thanks as always for taking the time out.